Welcome to the EY Next Wave Private Equity Podcast, where we explore what's happening now, next, and beyond in the world of PE. Digital, sector, talent, value creation, ESG. These topics are top of mind for executives across the global private equity ecosystem. Join us for the insights you need to reframe the future of private equity. Now, here's your host, Weena Brown from EY.
Today I'm joined by Jeff Vogel, head of the software strategy group for EY Parthenon. Jeff's primary focus is on advising private equity companies on technology acquisitions. Now, Jeff, I've spoken with a number of PE operating and deal team partners who trust your judgment implicitly. They say you call it as you see it, both the good and the bad, and this has earned you and your team the reputation of being the go-to guys in technology commercial diligence. I'm really excited to have you on the podcast today. Thanks so much for joining me.
Pleasure to be here.
Why don't we start with the basics? I've heard you mention the software economy on multiple occasions. Would you be able to explain to our listeners what that is?
Sure thing. Software economy is a term that I believe was invented by my partner at our predecessor firm, Bulger Partners. That's Chris Bulger. And by software economy, first we mean the obvious, which is software companies that sell or license software or even software subscriptions or SaaS companies. And then this whole other slew of companies that are really software-enabled business services, but not any software-enabled business service, a software-enabled business service where the proprietary software, the technology that's built by the hundreds of engineers and the tens of millions of lines of code and possibly the hundreds of patents that a particular company has, where that software enables the company to compete and they differentiate on the basis of their software. Another way to think about this is really the economy that Marc Andreessen described. In 2011, he wrote a pretty famous op-ed piece in the Wall Street Journal called "Software is Eating the World." People may have heard that expression. That's where it came from. It came from the title of that op-ed piece. And Marc talked about a bunch of companies that he called software companies, but they really weren't software companies. They didn't sell software. And he talked about the largest bookstore in the world being a software company, Amazon. He talked about the fastest growing entertainment company in the world being a software company, Netflix. He talked about the largest recruiting firm in the world, LinkedIn. And he talked about the largest marketing firm in the world, Google. And none of those four companies sell or license software. Google sells ads. 98% of their revenue is from ads. LinkedIn sells jobs or recruiting ads. Netflix sells movies, right, and TV shows and entertainment. Amazon, right, at the time, this was almost pre-AWS, Amazon sold books and sold everything, right? Hey, everything but software, really. But all those companies, they hired thousands or tens of thousands of software developers. They probably have hundreds of millions of lines of code at this point, and they certainly differentiate on the basis of their software. And Marc didn't even mention Uber, okay, because Uber did not exist in 2011. And that would be an example, of course, of a software-enabled software economy company that does not sell software. Uber sells transportation services, right? So that's what we mean by the software economy.
So when you say that, does that mean when I think of technology and software company deals, we're not really talking about a company that sells code or sells an ERP system? We're talking about a company that sells potentially a service or something else, but just happens to be technology enabled?
Well, we're certainly talking about both, but yes, a growing proportion of the software economy is no longer software companies. Because all those companies I mentioned, many of the unicorns and certainly the Ubers of the world, the Teslas of the world, the Googles of the world are not selling software, and they make up a big proportion of the software economy. So correct.
So when we think about PE and their investment in the software space, where are you seeing the deals?
Yeah, so it's interesting. So there's clearly, right, a slew of, you have the first generation. Let's talk about upper mid cap and large cap private equity, right? There was an early generation that started investing in software 10 to 20 years ago, right? If you go back 10, 15 years, private equity firms didn't invest in software because they didn't get it. Like they couldn't understand these crazy valuations. They didn't know about businesses that had 95% gross margin. It was really not something that they understood. So there were some early players that started doing that. And then, of course, over the last 10 years, given the growth of the software economy, everybody and their brother said, we better learn how to invest in this. And they started where they were more comfortable, which was business services, software-enabled business services. And some of those were more software-enabled than others. So some of them I might not consider the software economy if there really wasn't any differentiating software. Like a lot of BPOs, business process outsourcing companies, use technology, but it's not really differentiated in any way. So I might not call them all software economy. I'm even an e-commerce player, right? A company selling stuff on the internet through e-commerce, if they're doing it through all off-the-shelf technologies, Yahoo storefront, Magento e-commerce engine, Shopify shopping cart, like it may not really be a software economy company. It may just be a retailer or a distribution company of some form. But when they're starting to leverage their own technology to do that, they cross over into software economy. And that's where many of the PE firms got busy because they're like, okay, we know a lot about business services. So moving into software enabled or tech enabled business services wasn't as huge a stretch. So you saw a lot of companies playing there. But meanwhile, some of those early players who got smart about software 10 or 20 years ago, okay, said, hey, in this new world, we're still going to play in core software or core enterprise software. And there's a lot of larger companies that have been around for 10 or 20 or 30 years and fit the PE portfolio, which is lots of recurring revenue, usually through maintenance, sometimes through SaaS, very, very sticky. So the customer base is solid. Some of them are going through some form of transformation, but there are now a lot of companies that are, at that stage where they're really good fits for private equity. So you do see large cap private equity players spending a lot of time in established enterprise software. And then you see some of the newer guys and the mid-market guys looking at this slew of tech-enabled business services because they understand it better because they're not all that tech enabled. And then, some of the newer ones are becoming more differentiated and more tech enabled than other ones. So that's sort of how we see the landscape of where the software economy meets private equity.
And so, I mean, obviously, what you've described is a very varied type of, call it software sector. How is PE evaluating these deals and evaluating these companies? Have they got all of this in-house expertise, or are they typically outsourcing to people like you?
Yeah. So same thing. So we built a business right on the backs of people outsourcing to us. Somewhat this trend that private equity folks, the large cap guys, are smart as all hell. They know what they don't know. And when they find advisors that they like, they're going to leverage that. And that's certainly been a big part of our success. Having said all that, the folks that have been around are also smart enough to know that if they can build some of these expertise in-house, that's going to help them differentiate and benefit them. So you are seeing the serious software investors have people in-house, right? The most notable, of course, is Vista Equity that has a whole consulting arm, okay, with lots of people who were former software practitioners. Then you see other private equity firms bringing in operating partners at some level where they were CEOs or executives in software companies. So some of that expertise is starting to make its way into private equity. And I expect that as you see the degree background of undergrad and even MBA and even master's programs, as more of that shifts to technical degrees, which we're seeing, I know that like when I graduated 30-ish years ago, 25 people in my graduating class of 1,500 had computer science degrees. Today, it's 250 at that same school at Brown as a great general background. And not all those 250 are going to go off and write code and be software engineers. They're just using it as a great general background in today's software economy. I think you'll see the same thing happen in private equity firms that, quote, generalists are going to join private equity firms, but the generalists are going to have pretty strong software chops.
Do you think then, given what you've just said about the workforce, you mentioned the Vista model. The Vista model is predominantly, I mean, all they do is invest in technology. And as you say, they've got a deep consulting arm that's focused on technology. Do you think that gives them a competitive advantage? Or do you think because people are coming out of university with a lot more tech smarts, it kind of doesn't matter because you've got these people embedded in all, even the general PE firms?
I mean, I think whenever you can get that many smart people together who share common vocabulary, knowledge, and experience set, it has to be an advantage, right? Vista has great pattern recognition because they've seen 5 of everything because they do so much tech investing. So anytime you specialize, of course, it's an advantage, right? You just develop great expertise, as long as you don't get tunnel vision. So I think it's why you have sector teams in private equity firms for the same reason. And then it's just a question of, can you do that at scale? A private equity firm may have a TMT team. That's good because those people get to have pattern recognition, but they're not seeing the same number of deals and deal velocity that a Vista that only does tech might see. So, it's hard to say that's not an advantage. The only other side of that is the side to a specialist firm that does things in a very focused way is it's not always one size fits all. And sometimes in the marketplace, when you're talking to portfolio companies or potential portfolio companies, while the focused firm might make arguably better investment decisions, portfolio companies like the broad approach because they get to leverage the portfolio. And one thing is that the tech companies get to work with the non-tech companies in a portfolio. They become business partners. They sell software to them, that kind of thing. And you see that the cross-silo horizontal nature of private equity firms that work across verticals has some advantages of its own.
Yeah.
But all things being equal, it's hard not to say that a firm that does a lot of transactions in a slice of the economy in a lowercase s sector is going to have some advantages that firms that are spread a little thinner just don't have.
Okay, well, that makes sense. And so, if we think about just investing in a software asset, how is it different when you're thinking about due diligence or you're thinking about making an investment of a software asset? Well, how is that different from investing in a traditional asset?
There's many ways to skin a cat. So the first thing I like to think about is when you think about the TAM or the addressable market for software, it's not just like in some consumer product company where there's 5 vendors that all make, coffee makers. I'm sitting here looking at a coffee maker. So how I think about TAM is really complicated. Like, is it just the TAM of the vendors, the vended market, or is it really all the different ways to solve my problem is the TAM? And some of them are paper and pencil and human labor. And at the other end is a commercial off the shelf app that I pay, $1,000 per employee per year for, or whatever the price may be. So thinking about the market and the competitive landscape is really complicated, first. Second, pretty high gross margins, right? In the old days of software, the first copy of the software cost a lot to build in R&D, and the second copy cost, at the beginning of my career, we would distribute stuff first on quarter-inch tape and then on CDs. It actually cost $50 to burn a CD back then. So the cost of goods sold was actually $50 and some postage, $10 for the FedEx to send it to the customer. Then in the world, we started downloading software. It was virtually free. So you had 99.9% gross margins often. And then in the SaaS world, gross margins came back down to something in, the mid 80s because you're spending some of that recurring revenue towards running the infrastructure for your client, right? Whether that be in public cloud or in a data center, it actually started costing you something to deliver your monthly obligation of the software. So very high gross margins. Second is the software is never done. Okay, so unlike the coffee maker or even unlike an automobile where every 5 years they might redesign it, the software is constantly evolving, right? There's a major release every year, a minor release every couple months. I'm fixing bugs regularly, or, again, in an agile SaaS world, the product might roll out with new features every 30, 60, 90 days more frequently. So the product is never done. So that R&D expense, while gross margins are high, that R&D expense is also pretty high. Or while COGS is low, you might say R&D expense is high because you're constantly have to be evolving a software product. So you have to look at it that way. So those are some of the characteristics that make software challenging, complex, but in our minds, more fun than any other sector.
What do you look for? And when you're doing due diligence on a software company, what do you actually look for as key signs or key things that will help you determine that this is a viable company?
So the biggest thing is, and this is a great segue to the prior question, is the concept of technical debt. So the biggest worry our clients have is that they acquire an asset and it has a ton of technical debt. So everyone says, well, what's technical debt? There's a few definitions out there. Think of technical debt as deferred maintenance. So when you buy a house or you buy a building, there's probably deferred maintenance. The roof may have to be replaced at some point. The HVAC system may need to be replaced. The foundation may be crumbling. There are these hidden issues, and they're not really on the balance sheet. These are liabilities, but they're not on the balance sheet. So unlike real debt, financial debt that's on your balance sheet, this is obligations that you are signing up for that you may not know you're signing up for, and they don't show up anywhere on the balance sheet. And it's really hard to find them and quantify them. All software has technical debt. If you built the software perfectly, you would be over-engineering it. It's like if you built the house to last 100 years, it would have cost you 3 times more than you needed to, and you would have over-engineered it. But you have to make trade-offs when you're building software. You have time to market. I have to get it out quicker. I need it to be fast. So this is a trade-off between making it fast and making it extensible forever and making it extremely maintainable. So architecture is making all these trade-offs. And as a result, just like private equity firms like to leverage their investments, having some debt is good. Having some technical debt is good. You need to have some, but you also need to manage it. You need to pay it down, and you need to avoid accumulating too much technical debt over time, because then you find yourself in a situation where every dollar goes into remediating technical debt and no money goes into building new features and competing with your competitors and differentiating your products in the marketplace. And that's really the challenge that our clients are most worried about, and where a lot of the time and product and technology diligence goes to understanding how much technical debt is being remediated, and is the company going to be able to devote the required amount of resources to things that are going to grow the top line and not be mired in technical debt remediation.
And this is the diligence methodology that you pioneered, one that actually elaborates or one that actually assesses the technical debt?
Yeah, so I would say that our team was pretty instrumental in sort of institutionalizing product and technology diligence for private equity, for companies of substance, where there's a lot of complexity, and we needed to, in a pretty short period of time, be able to assess and quantify things that were going to matter for pretty substantive investments and acquisitions.
Okay. And in order to do that, I'm imagining that, from what I understand of your team, you've got deep talent. You've attracted ex-CIOs, a lot of the people that you talked about that have technology degrees. How do you not only attract the right talent, but also train them and continually upskill them, given how quickly technology is evolving?
It's multifaceted. You're right. Like early on, recognize the need to build out a team of really strong, mostly serial CTOs, pretty experienced people. And what we have done is combine that team with a team of, so that's a pretty senior / older team. And then we have a young team of people that come out of top schools and pretty interesting software companies at the early parts of their career, usually with technical backgrounds, computer science degrees, product development, product management, sometimes solutions engineering. And then you marry this together. So you marry some really experienced people who love working with young people, and it sort of keeps them energized and motivated. And the young people love learning from the more experienced people. And it's wound up being, a pretty good formula for our success. And like all good things, we stumbled into it, and it was better to be lucky than good, but we came up with the right formula, and it's been working well for us.
So your secret sauce then is people, essentially, and a passion for technology.
Yeah. I mean, I think we're definitely a people business, and there's no doubt that our success is 100% attributable to our great people.
Cool. And so if we think then, so you guys now have done the diligence and you've helped PE make the decisions around where to invest. If I think about traditional PE, it's all about value creation once you've made that investment. Where do you think the value creation levers are typically when you have a software company, given what you've described so far?
Yeah, so that's a great question. I mean, a lot of the companies that our clients acquire are thinking about heading towards in the middle of some form of tech transformation. So helping them get that right with the right cost structure and the right risk mitigation is pretty important. So they might be moving to the cloud. They might be taking an on-prem product and making it SaaS. Often a constant theme is 2 + 2 = 5. No secret, valuations are through the roofs. So in order to make the math work, it's not uncommon for our clients to look for synergies and acquisitions and scale that they could build in the companies. And when you take 2 or 3 things, putting them together in a cohesive way is non-trivial. Which products do you keep? How do you consolidate? Do you consolidate? What's the impact to customers when you do that? A pretty common thread is the asset in some of these companies is the stickiness of the customer base, right? So people always talk about recurring revenue, but why is revenue recurring? Contracts are rarely, more than 3 years. So it's not contractually recurring. It's that customers have products that they like and they're sticky and they don't want to move. So if you radically change the platform such that the customer has to go through pain to stay on your products because you went from version 5 to version 10 or version 5 to next gen is a common thing. If that was hard for the customer, they would say, well, I might as well go to RFP because it's going to be painfully easy either way. You want to avoid that. We are often tasked with helping our clients come up with ways to remediate the technical debt, modernize the software, but in a way that's behind the scenes, under the covers, and does not cause friction with existing customers. And that's way easier said than done. So a lot of the value creation is that it's like a going forward technology roadmap that optimizes the trade-offs between modernizing, adding capabilities, and being low friction for existing customers.
So the way you've described how technology companies and software companies are evolving feels like it's a more of a long-term play. And when I think of PE investments, they're typically short-term.
Yeah, well, they're becoming shorter term, right? I mean, probably when we started this, 4 to 8 years was the average, 5 to 8 was the average hold. And then you've seen a lot of stuff flip. Like, we've been doing this since we're seeing things for the third time that we worked on in 2014, 2017, 2020. And that's pretty unheard of, like two flips in 3 years each. But at the same time, we're also seeing some of the best investors in the world decide that they want to hold companies for 10 or more years. And sometimes that's a fund to fund, like they sell it from, fund 6 to fund 9, because their limited partners see value in holding software companies over the long haul. And I think everybody kind of values the decisions that are made when you're long-term oriented. So all that comes to play. I think even in the short-term scenario where someone's thinking of holding it 4 years, they also know that the company has to look right upon sale. So you still have to make 5 and 10 and 15-year decisions, right? Because it's not uncommon to be having a conversation. It's not just about like what we do with the company, but you can't sell the company while there's a major investment. If I were purely maximizing cash flow and not, let's say, sale value, you might say, okay, don't remediate the technical debt, maximize cash. But I know that I can't sell something that has all this technical debt to the next player, because they're going to say they got a major overhaul on their hands, and that's going to impact exit valuation. So you wind up having to take a 6, 7, 8, 10-year lens to something, even in the case where you might have a client that says we're flipping this thing in 3.5, because usually whoever they're flipping it to is a pretty smart investor themselves, and the next 5 years has to make sense as well. So we don't really see ourselves in too many situations where we're optimizing for the short term.
And that's probably a distinct difference between an investment in a technology company versus an investment potentially in a product. Because like you say, your coffee machine is there's your product, you turn more products, but you've got the R&D that needs to happen for tech companies. Otherwise, you're dead in the water, right?
Exactly. And some of this is the results of the valuations of the last 24 months. Everybody has to underwrite growth. They can't just underwrite cash flow because they're paying crazy numbers. They're paying 20 times EBITDA on everything. And you can't get there just on underwriting cash flow.
And so what do you think? I mean, technology is changing at such a fast pace. What role do you think PE is going to play in shaping the technology sector for the next, call it 5, 10 years?
I mean, I think a pretty significant role. I mean, the last 6 months notwithstanding, tech IPOs had slowed a little bit. There's lots of trade-offs on whether you want to be public or private. I mean, I am very appreciative of our clients, not just because they've been good to us, but I really do think they're company builders. This notion that private equity guys are cut and slash, we just don't see it. Or we don't see it in tech anyway. They're company builders. And as I said, they need to grow companies in order to be successful. They can't just milk the cash. They tend to make long-term decisions. And, if I'm a software executive, boy, would I rather be in a private company without the quarter-to-quarter lens that's required, where I can make longer term decisions, one that's owned by private equity versus a public company where every quarter matters, and you don't always really have the liquidity, right, for lots of reasons. So because of all those things, I think you're seeing more and more management teams, CEOs, founders see the benefits of being parked with private equity. You see many that have gone public and have decided to go private again because of that, because some of the virtues of being public weren't all that they were cut out to be in terms of liquidity and availability of capital and other things. Private equity has $1 trillion plus the leverage on that of dry powder, and it's looking more and more towards tech to deploy that.
So I guess from a technology company's perspective, very clearly access to capital is hugely important. And I guess from a private equity perspective, technology companies are hugely profitable. So also win-win.
The only downside is the valuations, right? Let the markets take care of that. I think the folks that have been investing in technology have seem to have the IRR to justify what they've been paying, and you can see record funds being raised, which is the proof is in the pudding.
Do you have any recommendations maybe for those PE firms out there looking for some really attractive potential targets? What would your words of advice be for them?
They're all pretty smart, so I don't know if they're going to get a lot of advice from me. I do think that staying long-term focused is pretty important. The PE firms and the portfolio companies that we've been involved with that have kept a long-term lens have done the best. There's some bellwethers out there in our client base and in our clients' portfolios. I alluded to some of these funds that are, holding companies for more than 10 years. Some of these companies are getting to the size and stature of the large cap public software behemoths because of that.
Jeff, before I let you go, are there any other trends that you're seeing that you think might be shaping the technology sector and PE investments over the short to medium term?
So that's a good question. And I think it's pretty relevant right now. And some of this is as a result of COVID. But I think something that we're seeing that should lead, in my opinion, to some good things, and it touches on the public versus private. We have seen some hybrid type deals. So what do I mean by that? I mean, some private equity firms that used to be majority control investors starting to do minority slices. We're seeing some pipes, some private investment in public entities. So public companies needing some capital, taking on a large private investor that's going to own a slug. You start seeing hybrid. You start seeing some of the great practices and detailed management and reporting and strategy expertise from private equity starting to permeate maybe some public companies or two or three PE firms that normally wanted to be sole or control investors partnering with each other. So a little more of this cross-fertilization and crossover happening. There have probably been times in history where we saw a little bit of this before, but in any event, we're seeing that now, and I do expect that to continue and see some more things that looked a little strange to us in the previous months, but we're now starting to see more regularly. And I think that's going to be mainly a good thing for both the public and the private markets.
Excellent. Well, thank you. I look forward to seeing all those transactions unfold. I think it's going to be exciting times in the sector.
Same here. Thank you, Rena.
Thanks, Jeff.
Thanks for tuning in to the EY Next Wave Private Equity Podcast. For more thought-leading perspectives and to get in touch with Weena Brown, visit ey.com/private equity. You can also follow us on Twitter at EY Private Equity. We'll see you on the next episode.